Ladies and gentlemen, please welcome General Manager WSJ Pro, Will Wilkinson.
We haven't actually transacted.
Thank you.
Certainly, we'll see all the deal flow.
Thank you very much, ladies and gentlemen. Good morning and a very warm welcome to this wonderful room in Boston. My name, as just announced, is Will Wilkinson. I'm the General Manager of WSJ Pro, which is a relatively new service from Dow Jones and the Wall Street Journal, targeting the elite practitioners in areas of business practice, like yourselves. Today's event is the first that we've done in this series in Boston. So it's wonderful to see so many of you turn out with us this morning. Many of you may have known the former products that we had, the LBO Wire, the Private Equity Analyst, and we've taken those and developed them into a comprehensive private equity service that we call WSJ Pro Private Equity, brilliantly. Our aim is to provide the same long-term service. We've been doing this since the mid-1990s, to continue looking at the trends, to continue providing the analysis that's relevant for the industry itself. But on top of that, it's also to bring the community together, to bring peers and colleagues and clients together at events like these that we will start to and continue to host in cities around the US and indeed around the world. It sits alongside other products that we're developing that look at financial regulation, that look at venture capital, that look at central banking, and that will increasingly look at areas like cybersecurity and anti-money laundering. But this morning is a chance for you to hear from some industry experts and also to meet some of our own experts who are your hosts at these events. And so it reminds me to hand you over to Amy Orr, our senior reporter, who is one of your hosts for this morning. I wish you an interesting and stimulating conversation. Thank you.
Thank you. Thanks. Ooh. Hello. Morning. Thank you so much for joining us today. We are very delighted to have Jonathan Lockvine, the co-managing partner of Bain Capital and also Chief Investment Officer of Bain Capital Credit. Jonathan joined Bain in '93 and he founded Sankaty Advisors in '97. Sankaty has recently been rebranded as Bain Capital Credit and is one of the largest and most experienced credit provider and investor. And right now, it actually manages about 30 billion of assets. So I want to actually start broadly about the market. The market has been very interesting this year. At the beginning of the year, there was talk about dislocations, credit has been tight, and then now all of a sudden it's borrower's market. So where are we in the credit cycle?
It's interesting. There's an expression that I use quite a bit. It's never as good as it looks or as bad as it feels. And what I think you see happening in the markets right now is pretty basic supply-demand. The market overshot in February. It got too tight, then overshot on the correction, and then is crawling its way back. If we continue to work in a supply-demand situation where it tightens, widens, and the dynamic continues to self-adjust, that's how markets are supposed to work. And you're supposed to show discipline as it gets tighter and do your work and make loans when it's more attractive. I definitely think on the par side, on the private lending side, I do think that there are pockets where things are getting too tight. I think going into an election that has an enormous amount of uncertainty, I was reading a research report the other day that described the market as absolutely fair value right now. So it was trying to make the point that, in a way, if everything is priced to exactly the right point, then the level of value is less than you would like to see.
And also hard for you guys to invest as well, right?
It is, although the way we're structured, we have 14 industry teams, and we have product teams and credit teams throughout the globe. And remember, when you and I talk about the market, of course, people presume we're talking just about the US market. And we make loans in Europe, we make loans in Australia, we've made loans in Japan, Thailand, and throughout the globe. And the markets are very rarely the same level of value in every geography. I think what you're seeing in the US right now, in the current spread level, is the economy is fine. It's not great. but it's not bad. It is certainly the best bet in town right now, relative to any of the other markets. And therefore, if you're looking for some level of relatively stable income and a relatively low likelihood of default in the short run, the U.S. is a pretty good place right now.
So in the U.S., you mentioned about pockets. So where are the pockets?
I think that there are some industries that are undergoing transition that you have to be very careful in. There are retail, in particular, there's all sorts of retail and consumer strategies that I think that people will have a blanket view of retail and consumer and not realize that one of the things that the internet has done is led to a very unique, very precise segmentation. You could almost go through a department store 20 years ago and look department by department by department and watch it get chipped away by the internet. I think that in certain pockets of energy, I think there's still some value because people way overpriced it, then way underpriced it. And now I believe that there are some people so badly scarred that they look at anything in the energy space and are like, I will never invest in that again. I will not touch it, no matter what the assets are. And then, I think that there's pretty fair value to be had in basic industrial, slow growth, cash generative companies.
On energy, I'm kind of curious, do you actually as distressed kind of play, or do you actually see the market kind of like already bottoming out and rebounding now?
Certainly, the distressed play in energy did not play out nearly as much, I think, as some people had thought. There was a lot of dedicated money, dedicated funds, quite large funds raised for energy, and we did not raise one. And I think that the market corrected pretty quickly, or corrected to a level that separated winners and losers, whereas before everybody was a loser and there was nothing but cheap value. But it was really, really difficult to. It was not obvious that it would turn around. Implicit anytime you're investing in energy, there is some unknowable of what is Saudi Arabia going to do with output, and I think that was something that was fairly unknowable, which I think put a chill on a lot of people. That said, I do think that there are energy names that work at the current strip, that work at 60% or 70% of the current strip. Capital is so dear right now that that there are opportunities out there, but it is back to being a niche, a large niche, and it is not everywhere you look there's value in energy.
What's your exposure in energy?
Our exposure in energy is fairly low. You have to go product by product by product. It's generally in the single digits. It was, I think at its peak, energy was about 15% of the high yield index, and then it became a huge percentage of the distressed index. Generally across our portfolios, it's been in the single digits somewhere.
And you want to keep it at around the same level?
But markets change. There could be things that happen at banks where banks have decided, a lot of people fight the last war. So banks may decide, I'm not going to lend to this industry anymore because it was mean to me last year. There may be regulatory issues. And there's also, I think one of the broader areas, not just in energy, is I think it's increasingly hard to get a loan to do CapEx, where you have to find a lender who's willing to dig in and understand what you're spending the money on, and that be able to think about the cash flows, obviously in the short run, but 3 years, 5 years, 10 years out.
We'll talk about direct lending in a bit, but I want to actually talk about distress because I understand that you guys raised around $3.5 billion in distressed debt and special situations.
Yes.
Does that mean that you guys expect a lot of distressed kind of opportunities coming up as well?
Yes, I think that right now, we definitely think there's a lot of distress out there, but it's mostly not in the U.S. Our last program in distressed was more than 50% invested overseas. There's still an enormous number of NPLs to buy in Europe. We have developed a particular skill in buying NPLs of what's called SMEs, small businesses, and portfolios in which this will sound large, but there are portfolios that sell for billions and billions, in the $300 to $600 million range. The largest portfolio we've bought was about $1.5 billion. But there's still over €1 trillion of NPLs to be sold in Europe. Then of the NPLs that have already been sold, there's individual assets, what you would call the lumpy assets. If a portfolio was monolithic, but what banks tend to do is throw 4 or 5 non-standard assets in there, a lot of those get resold and if banks are focused on selling NPLs, then they're not focused on making new loans. So we've set up an office in Dublin a few years ago because we think that Ireland did a really good job cleaning up their banking system, but that resulted in not a lot of small business lending available. Going across the globe, we have had good success in Australia, which is a very non-traditional market. I think it's because it's far away. We have an office down there. We bought Lloyd's residual portfolio. It was about 10 names down in Australia. We bought GE Capital, all their books down in Australia. We bought JP Morgan's Global Special Situations book, they called it.
So it's a play on like kind of global financial institutions divesting like part of their non-core, kind of geographically non-core kind of portfolio.
And they sell for 2 reasons. One would be because they have to sell, and another reason would be because it's non-strategic. So GE Capital, JP Morgan, non-strategic. Lloyd's and a lot of the European banks, it was because it was mandated as part of their restructuring.
I want to bring it back to the US. I'm kind of curious. So you were talking about distressed kind of situations, mainly overseas. What about the US? What are the kind of factors that you're looking at that might actually tip us into a distress cycle?
Sure. Well, distress cycles can come for a couple of reasons. One is actual economic distress. 2 is a market dislocation. And without making any predictions or anything, our election could definitely create a dislocation of some sort.
Is there a disclaimer? Do we actually need to talk about who do you support?
I absolutely support Hillary Clinton. But remember that this election is going to have lots of interesting things: the House, the Senate, individual races, who becomes chairs of different committees in the Senate. Interestingly enough, no matter what happens, it's going to be new. And then our companies that are doing okay in a very slow growth environment, are they finally going to not be able to make it? Once again, I think that there's consumer names. I think that there's things in energy. Coal, obviously, continues to need to be restructured. And I think there's certain media assets. With all the consolidation that's happening in media, there's been some interesting things that we've done in small-town TV, small-town radio, companies that have to manage or have not successfully managed and now are restructuring the move from print to electronic. So I think that it's going to be very company-specific and very industry-specific unless there's some unforeseen event in the U.S. economy.
So you're not expecting anything like the market tanking overall and then not an overall kind of distress situation?
I don't expect it. I think you always have to be ready for that because obviously if you could predict when markets are going to tank, then you could make an incredible amount of money. But the rest of us just have to work really hard. I would tell you an interesting thing. People always look for inflection points.
Yeah.
I was looking at some statistics the other day. 70% of all the money that's ever been made in high yields has been made on the coupon.
That's kind of like slow burn, right?
So you might be able to time it perfectly. But in general, over time, if you buy a high-yielding asset and have low defaults, you're going to do okay.
Cool. I want to talk about lending because you were talking about how some of the companies are not actually kind of restricted because of the bank not lending as much. And you guys actually just raised a BDC for the first time, right? And I'm kind of curious because BDCs right now, it's totally not in fashion. It's been like that for 2 years. Many of them all started with the energy exposure. People are concerned, and then the NAV, or the stock prices actually dropped below NAV, so they can't actually raise new money to make new loans now. So to actually to have a BDC raised at this point sounds kind of like counterintuitive in the way. Do you mind explaining the rationale?
Sure. I don't know if it's counterintuitive. It might be a little bit contrarian. For all the reasons you described is the reason we did it. We have studied this industry for, in this part of the industry, we've been making private loans, and we've been making both senior and junior direct loans. I think we've invested about $6 billion in our history. We historically, there were several features of BDCs we didn't like. And we wanted to watch the product evolve, and we always said, if it's a good long-term product, because the first time it was shown to us must have been 7 years ago, 10 years ago, if it's a good sustainable investment product for us to manage, for investors to participate in, then it will be good 5 years from now and 10 years from now.
What other features you don't like?
So I think that a lot of BDCs relied on the 20% exemption bucket, where you have to do 80% of very standard direct loans, and then they get their juice, if you will, from the other stuff. I think a lot of assets that were ill-advised to be put in a levered entity got put in there, whether it was equities, co-invests, CLO equity, which we think CLO equity is really attractive. I just don't think it's appropriate to lever it in a BDC, and it led to industry concentrations. I think that people advertised a very big dividend yield in a very low interest rate environment, and we were able to go out and show investors who have known us for a very long time, this is what we're going to do, this is what we've done with these assets, and we're actually going to keep it fairly pure play. We're not actually going to go for the biggest dividend you can possibly get, but we are going to go for what we would consider a safe one, an attractive yield, but we're not going to swing for the fences. If we want to do distressed, if we want to do equity, if we want to do CLO equity, we have other vehicles we can put that in.
Nice. I'm going to open up to the floor, so if you have a question for Jonathan in a bit, please prepare it and also raise your hand. We've got microphones on two sides of the room, so the microphones can come to you. And when you do ask a question, can you actually state your name and your affiliation? But for the time being, can I ask you about the private credit industry, which you started 20, 30 years ago when private credit was not in fashion. Private equity doesn't do private credit. All of a sudden, the market has boomed quite a lot. And there's a lot of dry powder currently. I think Preqin data was talking about like 200 billion dry powder and around 150 billion being raised at the moment. So do you think it's healthy?
You know, in any market I'm participating in, I would prefer that fewer people actually join us. There's a big difference between what people are trying to raise and what they actually raise. Right now, we think that it is pretty close to equilibrium, because when you look at those numbers, you have to also look at the number of banks that have exited the space. You have to look at the banking regulations on levered assets of the banks that are still in the space. And you have to look at the amount of dry powder in private equity and in middle market private equity, put a multiple on that. And it's not crazy out of whack. That said, you're going to say, there are occasionally new entrants. And they come in and will do 1 or 2 or 3 loans to get into business, and they will muddy the market. And when that happens, you have to step aside and let them fail. Because we saw that in the CLO space in 07, 08, 09. The industry consolidated, and it's more traditional managers.
Does consolidation means that you guys can actually step in and buy some portfolios here and there that might actually fit in or complement your existing portfolio?
Yes, we've bought 4 middle market portfolios since 2010 of people who either got into the space and figured out it was non-strategic, or people who may have gotten out over their skis a little bit and needed to hive off a piece of a portfolio to focus on other parts of the business. I think the last thing that is important to understand on the middle market space is, once again, that's a very big space. And there's people who describe middle market as $250 million loans. And there's people who describe middle market as $10 million loans. We generally focus on companies from 10 to 75 million of EBITDA, which will bring us to invest normally 50 to 150, 200 million.
Okay, I'd like to open up to the audience. Does anyone actually have a question? The gentleman over there.
Thanks very much. John Dunn from Wells Fargo. Jonathan, could you comment a bit on what the regulatory environment for the banks has meant to the private lending space recently, and then going forward, how that will continue to impact the private credit space?
Sure. I am by no means an expert on bank regulation, but there's two things that clearly have affected the banks. One is just general leverage levels, and if they feel that they're going to have a loan looked at, and they will have a tendency to basically turn it down or do best efforts. The second thing that we've seen is a lot of times there'll be an early look, and they'll be looking to us and a couple of people like us to co-underwrite. So when they go to their committees, when you go to your committee, they know I've got these 4 anchor orders, these 2 anchor orders, so that you're not getting stuck with it. I think that they're different contexts, but I think that there were a lot of lessons learned from the hung deals in '08, and I think people want to make sure that they're willing to give up some economics to pre-sell deals. I think that there are more and more bank deals that are syndicated, but really are clubbed among 4 or 5 people.
I think, question from here.
Oh, sure. Paul Lippy. So if you look at the recent Caesars restructuring, it seems like some of the PE sponsors might have slightly sharp elbows when it comes to dealing with the creditors. I assume, I'm not trying to put you on the spot, I assume you don't invest along with Bain Capital on the equity side, but if in general you sort of extrapolated from the Caesars experience, how would you think about kind of that trade in terms of the relative risk of a lender in a PE-sponsored deal versus other kinds of deals?
Sure. So we do make all our decisions independently and have separate investment committees at our firm. I don't think that the Caesars deal is indicative of anything that you would possibly see in any normal restructuring. I mean, there will be business school cases written on this, and law school cases probably, written on that for years and years and years. There's 2 types of restructurings. There's restructurings that center around restructuring the company, and then there's process restructurings, where it's about litigation, who gets what asset. We tend to focus on the business side. We occasionally will do the other, but Caesars, Lehman, things like that became sort of litigation festivals. And I just don't think that that's indicative of anything to do with what most sponsors do. And I don't have all the specifics of Caesars. Fortunately, we were not part of it. But I just think that the time it was done, how it was done, the propco, opco, the multiple sponsors, I think the very aggressive distressed debt players on the other side, I just think that that was a confluence of events that I don't think you'll see again. Lastly, I'm not sure you'll see restructurings of that size for a while, because I think that there are some buyouts that have been done, but sort of those mega club deals don't seem to be back yet.
It's interesting, the gentleman's question, because a lot of people think that if it's a credit unit under a private equity shop, that there would be quite a lot of liaison between the 2 groups, but then what I've also heard is that there is a strict Chinese wall between the 2 of them. I'm kind of curious, what's your take on it?
Yeah, I mean, we've been doing this a very long time, and we are very, very sensitive to, one, all of our businesses need to make sure that they can be, stand on their own and be leaders in their own market. The value of being under one umbrella should be, industry knowledge, joint learnings, just general scale with vendors. Individual insights on individual credits, I actually think is more rare than people realize. And certainly, if our private equity team were to get our help on a restructuring, we would not participate in that restructuring on the debt side, period, full stop. We would just be restricted. So I do think that the perception, all the firms that have credit firms and private equity arms are quite large and have large scale, and I think most of them now have independent credit committees making independent decisions.
Sure. Do we have more question? The gentleman over there.
My name is Jose Luis Martinez. I'm from Ivonix. We deal with industrial instrumentation and electronics for Latin America. How are your investment in that region? Do you have exposure there, or are you planning to invest in Latin America?
We do not have many. We have one investment in Latin America. It is a space that we continue to look at, but given some of the currency issues, some of the bankruptcy processes don't look yet like a U.S. process, and given the opportunities we see elsewhere, we have not invested much in Latin America.
Cool. Is there any more question? I have one. Can I ask, so you were talking about the mid-market lending, and then, but what I'm at the back of my mind is thinking about like sponsor-backed M&A activities have been down, so I'm kind of curious, what do you think of that? Are there enough deals to actually spread around?
Sure. One of the things that I think lenders in general have to learn as they, as their businesses develop, that more than just private equity sponsors borrow money. Family businesses borrow money, entrepreneurs borrow money, what's called fundless sponsors, somebody who may have spun out. And we see lots of opportunities like that. Good regional businesses in geographies like Australia. We've seen some entrepreneurial businesses. We've backed some fundless sponsors in the United States. So I think it's all about your sourcing network, and you should make sure that you source from not just the obvious.
How big is your team?
So the total team at the credit business is about 240 people, and 120 of them are on the investment side. We have about 30 people dedicated to the private lending business, and we have another 35 people who are generalists in the industry research area. So we have a lot of people looking at these things.
Nice. I want to actually kind of end this conversation given the fact that right now private credit is hot, right? But then it wasn't the case. So I'm kind of curious about what do you feel about both being an investor in the field for so many years, but also now, given the fact that you guys just been rebranded as Bain Capital Credit, and also you're now a co-managing partner for not only being the credit unit, but also Bain Capital itself. So I'm kind of curious, how do you feel?
The way you describe it, old. It's an honor to be asked by my partners to be one of the co-managing partners. I think that the scale of credit in the alternative asset universe, I think as such, we're $30 billion of a $75 billion firm. But I think more broadly, credit has become an asset class. And think about the things we've talked about today in terms of distressed and par lending and syndicated bank loans in Europe and Asia. So I think that as it's become a mature asset class, I think that it can attract investors who want scale and really have come to understand and appreciate, particularly in private lending and in investment, that it's all about not losing money. But if you do a good job, you're going to get a set return within a range and not lose money. And that's what good par lenders are supposed to do.
Fantastic. On that note, I think we are running out of time. Thank you so much. Please give a round of applause to Jonathan Levine. Thank you. Thank you so much. Okay. I'm going to invite my colleague Laura Chrysler to come up, and I think they're going to make some adjustments to the floor, but please hang tight. Thank you.
Thank you.
Thank you so much.